Thank you so much. So this session is to explain one of the key free cash flow formulas. There are many formulas that you can use. The most used ones, and I would say the best one, is our free cash flow to the firm formula. Just to recap, if you have a firm company, the company operates, generates cash flow. However, this cash flow is not free because the company needs some of this generated money for CAPEX, for investments, and for net working capital. Yeah, so part of this goes to CAPEX and net working capital. Yeah, we talked about this in some of the other sessions. What is left over, this is what we called free cash flow because it's free. It is not needed anymore. And when we say free cash flow to the firm, that means we consider both shareholders and debt holders. There are other formulas, free cash flow to equity holders. This is the free cash flow part that only goes to share or equity holders. But the formula we are using is the free cash flow that is available here. So we are not deducting any debt holder related items. So what we are going to do is the main formula, free cash flow to the firm equals EBIT 1 minus T plus depreciation and amortization minus change in net working capital minus CAPEX. Yeah, and how to think about, let's get started. Our first item is EBIT. EBIT we find in the income statement. So when we start with revenue minus cost of goods sold, gross profit minus SG&A, EBITDA minus D&A, EBIT minus interest minus taxes, net income. Yeah, so here, very easy. Why do we start here? We can't start higher. We can't start with revenue or EBITDA or gross profit because if we use revenue, gross profit, or EBITDA as a starting point, as an approximation for free cash flow, then we can see the cash flow approximation is not detailed enough. There's a lot of stuff that the company needs to pay before. So here when we would use revenue as a starting point, wouldn't work. We need to pay our suppliers for raw material, SG&A and other items, IT systems. We would need to pay our employees first. So what we do is we go down as much as possible. So we start with EBIT. Okay, why do we not go even further down and start with net income as an approximation for cash flow? Because net income, especially here, you have already paid some debt holders with interest. So we are saying we want to look at free cash flow to both. If we would use net income as a starting point, then this is not free cash flow to the firm because we have already paid debt holders. Yeah, so net income goes too far down. So that's why we start with EBIT as an initial approximation for free cash flow. What we do is we need to exclude the tax part because again, EBIT is not free for all. So if you make 100 in EBIT, you can't use 100 to pay your shareholders and debt holders because you have to pay a certain percentage in taxes. That's why we exclude the tax part here, EBIT times 1 minus tax, because taxes is paid to the government. Good. That's the first part. However, we need to do certain adjustments because the income statement, if you look at this, and EBIT is still not clean. And our free cash flow, if we use EBIT times 1 minus T only, it does not give us a full picture of whether this is the free cash flow really available for our capital providers. So what we do, we add back D&A. D&A is a non-cash item mainly for tax purposes, which we have deducted here, but nothing has happened. So our bank account has not changed, even though we have deducted D&A. We use it for tax purposes if we buy a machine and we depreciate the asset over its useful life. We do it for tax purposes. We need to add it back because our EBIT number here is too low. It does not reflect our full free cash flow position. So we add this back. Number one. Number two, CAPEX. As said here, we are still somewhere here. We need to see, okay, free cash flow generated. However, the cash flow here does not fully go to our shareholders and debt holders because we need to reinvest. Maybe we need to buy additional assets, additional machines where we want to set up a new plant. So some of our cash flow are used for investment purposes, CAPEX, which we need to deduct. Yeah, because it's always a trade to say, okay, do we pay out our capital providers or do we invest? CAPEX can be found in the cash flow statement. It's sometimes labeled as purchase of PP&E, property, plant, equipment, capital expenditures, or investment in fixed assets. You can't really see it in the income statement. It is connected with your D&A amount, but what you could do if you need to calculate or estimate your CAPEX, you could look at your balance sheet ending PP&E minus beginning PP&E plus D&A from your income statement. Yeah, just again, please be cautious when you combine income statement numbers with balance sheet numbers. Yeah, so then we have CAPEX. As an adjustment, the last one is net working capital. And net working capital, we talked about it, especially net operating working capital. Net operating working capital, which is accounts receivables plus inventory minus accounts payable. And here the main reason is all those different items, especially revenue and cost of goods sold, again, they are not clean. Because we use accrual accounting here, we record revenue and COGS when they are earned, not when they are paid, which means your revenue position, if you have recorded 100 in revenue, it does not necessarily mean you have 100 in cash. Yeah, if you have sold your product on credit, it could be that only 80 was sold in cash and 20 was sold on credit, which would mean you have an item accounts receivables, and we need to adjust for this. Same applies when we look at cost of goods sold. It could be that you have paid your supplier initially 100, but you have paid 80 in cash, 20 on credit, would mean accounts payable. Yeah, so we need to do those net working capital adjustments. I have done another video on net working capital because the income statement line items do not fully reflect our cash position. Yeah, so that's what we do because net working capital is the amount that is tied up for our operations, inventory as well. So if you have purchased a lot of inventory, your income statement does not tell you the story, does not show you how much money is actually used for inventory. But what we know is if your net working capital if more money is tied up in your operations from one period to the other, then less cash flow is available for your share and debt holders. So more cash is needed for your operations. Yeah, we do those adjustments. Free cash flow to the firm, EBIT times 1 minus tax rate plus D&A minus change in net working capital from one year to the other minus CAPEX. Really important, CAPEX, if you spend now, it's a cash outflow. D&A, it's a non-cash item that we add back. Net working capital, very important. From a company perspective, it's only considered a reduction in cash if we need more net working capital. Yeah, so then from a company perspective, you need to pay more money for your net working capital and less money is available for your capital providers. Good, I hope that makes sense. Key formula that is used in practice when calculating your discounted cash flow and when valuing a company. Thank you so much. Talk to you later. Bye.